Welcome to the deep dive. You know that feeling, right? Watching your investments, the numbers just dancing on the screen like leaves in a storm, and your gut just screams, sell! Get out now!
Oh, absolutely. And that moment, that visceral reaction, that's really the battleground for modern investing. It's our ancient human brain, wired for fight or flight, trying to deal with market data flashing by at light speed.
Something it was never designed for.
Exactly. Our emotions, quite frankly, can be the biggest liability we have.
And that's precisely what we're unpacking today. We're diving into Michael Bailey's book, Stop, Think, Invest. It uses behavioral finance to really shine a light on how things like fear, greed, and overconfidence can just sabotage perfectly smart financial plans.
Right. The goal isn't just to understand these traps, but to find a way through them, to build a structure for making calculated choices, moving past that emotional vulnerability.
The book actually lays out a strategy, doesn't it? A 12-step plan.
It does. And it's grounded in some serious research. We're talking Nobel Prize-winning work that shows human irrationality isn't random. It follows predictable patterns. If you can spot the pattern, you can build defenses.
Okay, so let's start right there. The old idea in finance was that we're all rational economic actors. We need to just, well, throw that out the window first, don't we?
Completely. We are definitely not always rational. Think about it. The wiring that saved our ancestors from, say, a tiger is the same wiring telling us to panic sell during a market dip.
Or maybe see a can't-miss pattern in what's essentially random noise.
Precisely. Those instincts were great for survival back then, but apply them to your investment portfolio. Not so helpful. Often disastrous, actually.
The book gives the example of Sarah, the executive. Smart person, successful career, started out doing all the right things with her investments, research reports, the whole 9 yards.
Yeah, she was diligent for a while, but then, the market's emotional pull got to her. Remember the tech stock boom in 2020?
Hard to forget, FOMO, fear of missing out, was rampant.
It kicked in hard for Sarah. She basically abandoned her careful research and started chasing momentum, buying stocks just because everyone else seemed to be making a killing. Stuff she barely understood.
And buying high like that inevitably leads to.
Well, when the correction came and it came sharp, the emotional pain of seeing those losses mount was just too much. She sold, locked in major losses, not because the world ended, but because the red on the screen felt unbearable.
That feeling, that's loss aversion, isn't it? The core psychological quirk.
It really is. Research shows we feel the sting of a loss about twice as intensely as the pleasure of an equal gain. It's a completely disproportionate reaction.
And that fuels other bad habits, right? Like holding on to losers.
Definitely. If you hate realizing a loss, you'll cling to investments that are clearly failing, just hoping, praying they'll recover. That's the holding losers trap.
While others are busy chasing performance, jumping in only after a stock has already soared. Buying high.
It's a cycle. Buying high, selling low, driven by these emotional responses.
I think most of us listening can probably recognize that feeling. Holding a dud stock for way too long, because selling feels like admitting defeat. It's almost embarrassing.
It is. But acknowledging that these are universal human tendencies, not some personal failing, that's the crucial first step. It lets you start building defenses.
Okay, so if these are universal, then even the professionals, the analysts, they must fall into these traps too. Bailey himself, the author, he thought his research was his shield, right?
Absolutely. He was a pro, believed in his rigorous process. But even he looked back and saw clear hindsight mistakes. The research process itself isn't immune to our psychology.
His big example was General Electric, GE. He had a very positive view built over years.
Yes, a strong thesis. But then evidence started popping up suggesting GE's earnings guidance was, well, let's say overly optimistic.
So the data was pointing one way. Why didn't he change his mind? An objective analyst should pivot, right?
But that's where the biases sneak in. Confirmation bias was a big one. He started, perhaps unconsciously, looking for data that confirmed his existing positive view and downplaying or explaining away the negative signs.
So seeking validation, not necessarily truth.
Kinda, yeah.
Yeah.
And then there's the sunk cost fallacy mixed in.
How is that different? It sounds similar sticking with something because you've already put so much into it.
They're related but distinct. Sunk cost here was about the investment of time and reputation. He'd spent ages building that GE thesis, put his name on it. Backing down felt like admitting all that effort, that intellectual capital was wasted. It felt too costly, personally and professionally.
Even if the stock price was saying otherwise.
Exactly. Plus, GE was this huge respected company. The halo effect was definitely at play.
Assuming past glory meant future success.
Right. And people love a good story, the narrative fallacy. Analysts often build a compelling narrative around a stock pick, sometimes glossing over data points that don't quite fit the story they want to tell.
It's easier to sell a story than a spreadsheet, I suppose. You also mentioned Bailey realized he'd been too trusting of management. He called it cognitive ease. What's that exactly?
Cognitive ease is basically our brain's preference for things that are simple and easy to process. We tend to trust information that feels comfortable, that doesn't require a lot of mental effort to challenge.
So GE's management offered optimistic guidance, which was the easier explanation to accept.
Then digging into complex, potentially negative counterarguments. Challenging the official line was hard work. Accepting it felt, well, easier. That's cognitive ease making you potentially complacent.
Wow. Okay, so even the most sophisticated research means nothing if you don't actively fight your own biases.
It really underlines the need for systematic checks, checklists, devil's advocates, pre-mortems, things designed to force you to confront uncomfortable possibilities.
Which brings us neatly to the next hurdle, actually pulling the trigger. Executing the trade. The book talks about an investment firm frozen over its AT&T position.
Yeah, the AT&T case is a perfect storm of execution paralysis. The stock had been, a stable dividend payer for years. But after they bought Time Warner, the debt load was massive. Their core business was struggling. The original investment thesis was clearly broken.
Intellectually, they knew they should sell.
They knew,
Yeah.
but they couldn't act. Why? Multiple biases hit at once?
Let me guess. Endowment effect. Valuing it more just because they owned it.
That's one. Then loss aversion. Again, the sheer pain of booking that loss felt worse than the slow bleed of holding it.
In status quo bias, I imagine. Sticking with the familiar, even if it's failing, feels safer than making a change.
It often does, strangely enough. Change feels risky, even if staying put is the riskier move financially. And yes, sunk cost again. We've held it this long. Selling now makes all that time feel wasted.
It's like quicksand. The more you struggle emotionally, the deeper you sink.
Complete paralysis. They were basically just stuck, hoping for something to happen.
And incredibly, something did.
Pure luck. An activist investor took a stake, the stock rallied briefly, and it gave them a, let's call it, face-saving way out. They got lucky.
But you can't build a strategy on luck. That reinforces the bad habit of inaction.
Precisely. It highlights the danger. Relying on luck instead of discipline is a terrible long-term strategy.
Okay, so if research is biased and execution is paralyzed, the only answer is those systems you mentioned, the structured approach. Bailey's 12 steps fit in here.
Exactly. This is where the structure becomes your shield. The framework forces you to do things like decide your sell conditions before you even buy the stock. Write down your thesis, write down what specific event or price target means, get out.
When you're calm and rational.
Yes. So your emotional self later doesn't have wiggle room to override the plan. It's like creating rules of engagement for your future potentially panicked self.
Like a pre-flight checklist for pilots, but for investing.
That's a great analogy. Checklists, mandatory waiting periods before acting on emotional impulses, maybe even getting an objective second opinion. Discipline is the only real cure for that psychological paralysis.
Which leads to the final piece, learning from mistakes, the growth mindset. Let's go back to Bailey and GE. He eventually sold, right?
He did, but much later than he should have. The stock had fallen significantly from the mid-30s down into the high teens. He narrowly missed an even bigger drop later. It was clearly a mistake.
But he didn't just wallow in it. How did he learn?
That's the key. He did a systematic postmortem. He didn't just say, oops. He diagnosed why. He identified that cognitive ease made him too trusting, confirmation bias blinded him to red flags. He dissected the failure.
And treated the financial loss almost like tuition.
Exactly, his words, valuable tuition. He used the pain of the mistake not to beat himself up, but to refine his process, build better checklists, become more aware of his specific psychological weak spots.
So it's not about never making mistakes that's impossible. It's about how you react to them.
It's that ability to look honestly at your performance, own the errors without getting paralyzed by regret, and constantly tweak your approach. That's probably the single most critical skill for long-term success in investing. Markets change, you have to adapt.
So wrapping this all up, it seems the big paradox is that our human capacity for emotion, which is vital in life, becomes our biggest potential weakness in finance.
It really is. Our feelings are both a strength and a vulnerability when it comes to money.
So the goal isn't to become some kind of emotionless Vulcan investor. That's not realistic.
Not at all. It's about creating enough structure, enough accountability, the stop, think, invest framework, so that your rational self, the one that did the homework, has the upper hand when things get turbulent.
And importantly, being kind to yourself when you do inevitably slip up. Because everyone does. Resilience matters more than perfection.
Absolutely. Learn from it, adjust, and move forward. Don't let one mistake freeze you.
Okay, so since we know even the absolute top pros are constantly finding ways their own minds trick them, here's a final thought for you listening. What's one single systematic check, maybe a preset sell rule, a 48-hour cooling off period, a simple post-investment review checklist? What's one thing you could implement, maybe even this week, to give your rational self a bit more power against the market's emotional roller coaster?